So again, good afternoon, everyone. So if we're here for the nonprofit breakout session. So if you were excited to hear about GASB updates, you're in the wrong room. So that's upstairs. But for all of you looking forward to discussing FASB updates, you're welcome, everybody. So for this afternoon, we'll be here for about an hour and a half talking about accounting, tax, and employee benefit plan that can impact nonprofit organizations. And I'll start with the discussion for accounting updates. So I'll go over the accounting standards update that has been issued for the past 3 years, focusing on three updates that can impact nonprofit organizations. So 2023-01, 2023-08, and 2023-09. I'll also discuss some technical agenda projects that's being discussed by FASB. So we're in the middle of 2025 already, but so far, FASB has only issued 4 accounting updates. So I would say like after the big standards such as the topic 606, revenue recognition, topic 842 that addresses leases, we are now in a period of a relative calm in terms of accounting standards. There's really no big accounting standards that we have to worry about spending a lot of time implementing. Let's see, 4 so far. But based on the review of the technical agenda projects by FASB, we are expecting them to issue 5 more before the end of the year, mainly focusing on credit losses, software costs, hedging, and derivatives. But just looking at the topics for those already issued for 2025, nothing really have any impact to nonprofit organization. In 2024, it's been a slow year for FASB. They only issued 4 accounting updates. Again, looking at the titles and the topics discussed, there's really nothing here that would have an impact to nonprofit organizations. In 2023, FASB issued a total of 9 accounting updates. And out of the 9, I would say 3 accounting updates would have not really a significant impact, but an impact to some nonprofit. The first one would be the 2023-01, which is an amendment to the leases standards. Also affecting nonprofit to a certain extent would be 2023-08, which discusses accounting and disclosure for crypto assets, and 2023-09 improvement to income tax disclosure. Now, for 2023-06, although it applies to SEC companies at the moment, and it discusses several disclosure improvement, there is a possibility in the future that it can apply or can be added to GAAP. For that to happen, SEC needs to instruct FASB to add the disclosure to GAAP. They have until, I think, middle of 2027 to do that. But until they instruct FASB to add this disclosure improvement, it will never be GAAP. So we're just going to wait on what's going to happen for that accounting update. So the first one that I want to really discuss is ASU 2023-01. It's an amendment to leases standards, and it covers common control arrangements. So as entities were implementing leases, issues or concerns was noted, especially for related party transactions. So when we're talking about common entities under common control, these are parent-sub relationships or maybe brother-sister relationship where the entities have the same parent company. So sometimes what they see is for the lease contracts between these related entities, they would see vague terms and conditions. And sometimes they don't even have written terms and conditions. So to address these issues, FASB issued ASU 23-01. Now, the number one issue that they address would be the terms and conditions to be considered. If you look back at the provisions of Topic 842, we have to evaluate what are the enforceable terms and conditions, because those enforceable terms and conditions would dictate how what is if there is a lease contract. It would also dictate the type of lease contract that we have, and it would also dictate like how we compute the right of use asset or the liabilities. So for related party or parties under common control, they came up with this practical experience. So if you have entities under common control and they have lease contracts between themselves, they don't really have, they can disregard the enforceable terms and conditions. All they have to do is look at the written terms and conditions. And based on that written terms and condition, that will dictate whether they have a lease contract and the type of lease contracts that they need to account for. The second accounting issue that this ASU addresses would be accounting for leasehold improvement. So as I mentioned, whenever we have contracts between related parties, typically the terms are vague. Also, typically, the terms are shorter. So if you recall GAAP, when we're amortizing leasehold improvements, it's the shorter of the remaining useful life of the asset or the term of the lease. So if we have related party transactions or contracts that would have a term of 2 years, even though one of the entity has spent substantial money on this leasehold improvement, they would end up amortizing it over 2 years. So substantial amortization expense in the financial statements. So now to address this, what this update is telling us is now if you have common control arrangements, you totally disregard the term of the lease. You just use the remaining useful life of the asset for as long as the lessee controls the asset. So the moment that the lease is with a third party, then you consider back determining the useful life of the lease agreement. But for as long as the lease is within the control group, you only consider the life of the asset in amortizing the leasehold improvement. And it's still subject to impairment guidance as well. It's already effective. So if you're a calendar year end, it was effective December 31, 2024. And if you are a fiscal year end, June 30, 2010. Another ASU is the accounting for and disclosure of crypto assets. I would say not a whole lot of nonprofit holds on to crypto assets. Typically, what we see in our clients is once somebody contributes crypto asset, they would immediately liquidate it. And if ever somebody or an organization holds on to a crypto asset, it's really because the donor restricted the liquidation of those assets. So I would say this would apply to a very limited number of nonprofits. But if it does apply to your organization, this ASU does define what crypto assets are included in the provision of this accounting standards. So I guess one that I want to highlight would be it has to be fungible. So that includes Bitcoins or Ethereums, something that can be replaced. What's outside the scope is the NFT, which is the non-fungible tokens. And just because of the nature of it, it's distinct, it's one of a kind. So it's harder to value. So it's outside the scope of this accounting update. And if you're holding on to crypto assets, it has to be measured at fair value. And any increases, decreases would be recognized in your changes in net assets for each reporting period that you're carrying the crypto assets. Here's a recommended presentation and disclosure for crypto assets. You have to show it on a separate line item. So it's an intangible asset, but you have, since it's being measured at fair value, you have to report it separately from the other intangible assets in your statement of financial position. Same with the changes from the remeasurement of your crypto asset. It should be separate from the other changes in the carrying amount of other intangible assets. Now, in the statement of cash flow, um, if you received a crypto asset and you immediately liquidate it, when I say immediately, we're talking about matter of days or a few weeks, you liquidate it. Then when you're presenting it your cash flow, you would treat it as operating activity. But in cases where you're holding on to the crypto asset for long-term use or long-term purposes, then it will be part of your financing activity in your statement of cash flow. For disclosure, of course, you have to disclose the name, the cost basis, the fair value, the number of units, and if there's one particular crypto asset that has a significant amount, then you have to show it separately, and then all others you could aggregate. You also have to state the restrictions on the crypto asset, if any. You have to show the roll forward of the activity, so additions, dispositions, gains and losses on those crypto assets, and also the method for determining the cost basis. It's effective for calendar year end 2025 and fiscal year end 2026. And if you're transitioning to this new standards, it requires a cumulative effect adjustment on the opening balance of your net assets. Now ASU 2023-09. So basically, I would say 99% of nonprofit, this would not apply. But if you have unrelated business income that's subject to tax, or maybe you have for-profit subsidiaries that's paying taxes, then this would apply to your organization. And what it does is it requires enhancement of the disclosure of income tax payment. One is now it's requiring a rate reconciliation. So for private companies and nonprofit organizations, you don't really need to show it in a tabular disclosure. Same with publicly listed company. You just need to provide a narrative describing what is really causing the differences between statutory income tax rate to the effective income tax rate that the entity is paying. Another is in your income tax payment. So you have to disaggregate between how much is federal, state, and foreign taxes, and how much is, and if ever there's one particular type of income tax that amounts to 5% or greater of the total amount paid, then you have to show it separately. Also disaggregating between domestic taxes and foreign taxes. And this is effective for calendar year end 2025, 2026 for public companies, but for all others like the private companies and nonprofit organization, you still have a few years like calendar year 2026 and 2027 to address the impact of this ASU. So nothing too exciting, right? So let me talk about other technical agenda projects being discussed at FASB. Currently, they have 12 projects ongoing. And as I mentioned, out of that 12, they're expecting to finalize and issue 5 within the year. I think one that would have an impact to nonprofit organization would be this amendment to CECIL, which is the current expected credit losses. So what it does is, like currently when we're looking at the provisions of the implementation of this allowance for credit losses, when you're estimating the allowance for credit losses, you not only consider the history, so history as far as collectibility from your customers, but you have to consider current conditions as well as reasonable and supportable forecasts. So since everybody basically has implemented this accounting standards, what FASB has heard, or the concerns that they have heard, is those that has implemented, especially affecting trade accounts receivable and contract asset receivable. So that's being recognized under um, topic 606, or its exchange transactions, right? So we know, like for nonprofit, grant receivable, pledges receivable, contributions receivable, they are outside the scope of CCIL. But if you have a trade receivable, for example, you have AR from students, member AR, or maybe patients receivable, then those fall under the scope of CCIL. What they did, what they consider was, especially for trade AR, since the collection is short term, they some of the companies that implemented CCIL, they were saying they don't really see the value in looking at the macroeconomics when they're developing the forecast, because you get to collect the accounts receivable on a shorter basis. And another provision of the CCIL is you're not allowed to consider subsequent collection of the AR. So you're calculating the allowance for credit losses without totally disregarding if those AR at year end was collected after year end. So what this ASU, the proposed ASU, will do is it gives you a practical expedient that the practical expedient applies to all companies. So for when you're developing the forecast, you can assume that what is current condition will be true for the rest of your forecast period. So you don't have to evaluate um, the macroeconomics. You don't have to look at, oh, what's the current unemployment trend, what is happening with politics, when you're developing your forecast to consider in your allowance for credit losses estimate. Um, and then in the accounting policy election, you could elect to say that for receivables that has been collected after year end, but before the issuance of your financial statements, it can be after the issuance of their financial statements. I mean, before the issuance of financial statement, or any date that you could say, like any receivable collected within 60 days after year end, we will consider in our accounting policy, and we will consider as part of the allowance for credit losses estimate. So what this accounting policy election is, any subsequent collection made will be disregarded. You don't have to compute the credit losses for subsequent collection. So now you can consider subsequent collection in your allowance for credit losses. Unlike before, that you're totally disregarding subsequent collection when you're coming up with your estimate for credit losses. Supposedly, this accounting update was going to be issued before end of quarter two, but we only have a few weeks. It might be issued early quarter three of 2025. But that's something that uh, we are looking forward to. That makes it easier for our clients to apply CSIL. Another project that FASB is working on is software costs. So if you look at the current gap for software costs, it looks at, so this, let me backtrack. For this ASU, it only covers internal use software. So it doesn't cover if you're selling software. It's really only for internal use software. In current gap, it's mainly centered on the stage of the development of the software. So you recognize or you capitalize software costs when you're in the developmental stage. So pre-development, it's expense. When you reach a development stage, and depending on the nature of the expenses, then you capitalize. And what FASB is saying, it doesn't really reflect how entities are now implementing or incurring software costs. So they want it to be more agile. So instead of just focusing on the stage of implementation of the software, now it sets a criteria when you could recognize or capitalize software costs. So that's something that FASB is deliberating on. It does, the moment that I think the proposed recognition criteria is management has to approve the cost, so it's willing to spend money on that software cost, and there's a probability to complete the project. So now you could capitalize those costs. So it's still under deliberation, but they are expecting to issue this third quarter of 2025. Accounting for environment credit programs. I think that this addresses potential liability if it's either government mandated or regulatory mandated, and it's for emission. So this ASU would give you guidance when to recognize environmental credit liability. But at the same time, for environmental credit that you create or you're able to obtain, it also provides guidance when you can recognize an asset. So again, it's being deliberated on, expected to be issued within the year. Here are some other technical agendas that FASB is working on. So some codification issues. They're working on a total of 34 um, accounting issues that they want to improve. And out of that 34, I think about 11 has some effect to the nonprofit entities. It doesn't have any significant impact to nonprofit organization. What it does is sometimes there's conflict between two accounting standards. So now they're correcting it. Sometimes there's wrong cross references between accounting standards. So they're also correcting that. Now, for example, the first one, update references for NFT presentation guidance. I think this pertains to fair value accounting. And then if you look at that literature, it's talking about how nonprofit will be presenting fair value. But when it refers to the financial statement of nonprofit, it it's stating balance sheet, income statement, rather than saying statement of activities, which is really, or statement of changes in net assets, which is more applicable to nonprofit organization. So those minor changes in the codification, and it's still under deliberation, and they have not published when they will be issuing this update. That's something to look forward to. So that's a very, I don't want to spend a lot of time on accounting updates because there's really no significant change in the accounting standards. As I mentioned, nothing to be excited about. But any questions on the accounting standards that I have discussed? All right. Well, thank you very much, everybody.